Star First Company sold 37,500 units last year at $42 each. Variable costs were $32.60 and fixed costs were $183,300. Prepare a contribution margin income statement for Star First Company for last year. We can do this without a problem because we've already gone over this. So we know what sales are going to be. They're going to be the selling price, which in this case is 42, multiplied by the number of units sold, 37,500. So that's going to give us total sales revenue of 1,575,000. Then I'm going to do, of course, the variable costs. Variable costs in this case are 32.60. Again, I'm going to multiply it by the same amount, and I can just pull this down. There we go. So variable costs in total are $1,222,500. I'm going to underline that. If I take the difference, this is going to be our contribution margin. Sorry, margin. There we go. Now, we can calculate those percentages that I mentioned before. This is 100%. This is almost 78%. And this is 22% approximately. I'm going to put it as a percentage. So we can see here, these are the percentages for this particular product. So now I'm going to do my fixed costs. And I'm going to subtract my fixed costs, which is 183,300. There we go. And this last number is going to be our operating income. Remember that operating income is equal to income before income tax. So on a regular income statement, this would be equal to income before income tax. So prepare a contribution margin income statement, already done. You can see how similar is it? It's identical to what we did previously, right? But this one, of course, is not a break even. We know it's not a break even. We can see that we're actually ending up with a profit right here. I'm going to just double underline the profit right here. Calculate the break even in units. So now let's think to ourselves, the number of units that's going to be break even. Will it be higher than 37,000, equal to 37,000, or lower than 37,500? I think it's going to be lower because remember that break even is when the operating income is equal to what?
0.
Exactly. So this is positive, which shows that we're selling more than we needed to sell. So if we're looking at a CVP graph, okay, I'm just going to quickly draw a graph here. Okay, so now I'm going to insert a line. So we've got fixed costs are right here. This is, let's say, don't forget, I'm just drawing this. This is the total cost line, right? That's the total cost. And then I'm going to insert a total revenue line. And I'm going to change the color of this so that we can see this is a total revenue line. So we know where it intersects right here is the break-even point. If we have operating income, we're over here. And if we're over here, that means we are selling more. So I'm just going to insert another line just to show. So this is break-even units. Right here, this would be the break-even units. That would be break-even units, right? If we are selling more than the break-even units, we're going to be way over here. Okay? So this is actual sales right here, right? So we can see that this is a margin of safety. And if we are selling right here, we've got operating income. So keep in mind, if we're seeing a profit here, that means that our break-even point in units is going to be less. Okay, so calculate the break even. We already know what that formula is. I'm going to just copy it from over here. We see here, break even in units. Let's copy and paste it. So we're going to take the total fixed costs, which we know is 183,300, and we're going to divide it by the contribution margin per unit. Contribution margin per unit is sales, $42, minus the variable cost, $32.60. And that's going to be equal to our break even in units. So this is units. So our break even is at 19,500. So if we go over here on our chart right here, this is going to be, this is going to be 19,500 units. Over here, our actual sales are 37,500 units. This is our operating income. I'm just going to insert right here. Because this over here, of course, on this axis, this is dollars. This is units. So over here, there we go. The space between these two, that is equal to 169,200. It's equal to $169,200. That's what we're looking at. Okay, so keep that in mind. If there's a profit, the break-even units are going to be lower. Calculate the units that Star First must sell to earn an operating income of $200,000 per year. Okay, so now we want units to sell is going to now be equal to total fixed costs plus our target operating income. And then it is all divided. All of this is going to be divided by the contribution margin per unit. I need to determine how many units I need to sell to make a target operating income. So I add the target operating income into our fixed costs, divide it by the contribution margin per unit, and it's going to tell me exactly how many units I have to sell. So units to sell is equal to, and we know it's equal to the $183,300, add in the 200,000 and divide it by our contribution margin per unit. We know the contribution margin per unit is equal to the $42 minus the variable cost of $32.60. That is equal to $9.40. So if we do that division, it's going to tell us the number of units. That is 40,776 units. Now we can't sell a 0.6 unit, so we're going to round this. I'm going to use the round function, round. I'm going to put this over here. I'm going to round it to 0 decimal places. There we go. That's how many units we have to sell in order to earn a $200,000 operating income. So keep in mind what we've done. The units to sell when we have a target operating income. And we know how, of course, a CVP chart works. It's usually called a CVP, cost volume profit analysis chart.